Hello everyone, Jeff and Jay here with another edition of Jay's Big Adventure. Jay's the fuzzy one. And it is snowing like crazy here in Salt Lake City, and today I figured we'd work on something that is pretty much universal if you're buying and selling anything. I don't care if it's a car, or a house, a big screen TV. You get a purchase price and then you go into a business office and they tell you this is how much the payments are going to be based on this interest rate in this number of years. The problem is, if you don't understand how to do these calculations yourself, you can really get hosed. A car dealership will almost always want to close you on payments. What can you afford? And then they will add all kinds of fees and charges and stuff to raise the loan amount up to what you said you would agree to pay. To avoid that, you have to be able to do these calculations. What I'm using is an HP10B, but financial calculators are all the same in terms of how you plug in information and how you manipulate that information. What we're going to do today is just go through some basic, simple payment calculations and show you how you can change those variables to get where you want to be. Okay, so when you're doing financial calculations, there are 5 variables that we have to account for. N is the number of months of the loan, not years, but months. So a 5-year loan is 60 months, 4 is 48, 6 is 72. If you're looking at a mortgage, 10 years is 120 months, 20 years is 240, 30 years is 360. The next button is interest rate per year. That's your APR for your loan, which is going to be 2.9, 3.9, 4.9%, whatever that is. Present value is how big is the loan? How much of a loan amount are we talking about? $25,000, $300,000, what have you. Payment is just that. That's your payment per month. The future value for these calculations is always 0 because I want the loan balance to get to 0. So that one's always going to remain 0. And to program this, all we're going to do is we're going to press 0. Okay, now my present value is 0. My future value is 0. And let's look at a basic loan amount. So we're going to go $25,000. And that's going to be right here. Our present value for the loan is 25 grand. And let's make it a 60-month loan, which is 5 years. Now, for a used car interest rates are 4.9%, something like that. So we'll go 4.9. You don't need the percentage. That's our interest rate per year. Now we've plugged in 4 variables. Now we can solve for the last one, which is payment. So 4.9% is $470 a month. Okay. This is where this gets really fun, is now we can change one variable and then solve for another one. So let's say $470 is just out of your price range. Okay, I really want to be at $399. Payments, as you see, are always negative. So what I'm going to do is I'm going to say, okay, I want my payment to be $399. Now, what do you want to change? Do you want to change your loan amount? I'm going to buy a less expensive car to get me there. If I do, that's call it $21,200. So we dropped from $25,000 for the loan amount to $21,200. If I do that, that gets me back to our $399. But let's say I really want to stay on that $25,000 car. So we're going to replace that, put that back as our present value. Now what I want to do is I want to change how long the loan's going to be. So I'm going to say, okay, for $25,000 at $399 a month, at 4.9 per year, how many months do I need to go to pay that off? Well, 72 months. So this way you can decide what variable you want to change and then tell the calculator, figure out what I need to do to get here. So let's go back and look at this another way. We're going to go back to our $25,000, make sure that that's correct. We're going to go back to 60 months, and we're back to 470. Here's where a car dealer will take advantage of you. Let's say that they close you at $500, okay? Sir, for this car, if I can make your payments $500 a month, will you buy the car today? And you say yes, and they say initial right here, and you initial right here. Okay, so now what they've done is they've closed you at $500. Okay, and we're telling the computer that's what I want my payment to be. What the dealership is going to do is add fees and charges, and they just got an additional $1,500 from you, because that loan amount is $26,500 to get you to $500. So what's going to happen is they're going to add all kinds of fees and crap in here to get you to $500 a month, and they just made $1,500 on you over $30. So let's look at it a different way. We're going to go back to $25,000. What interest rate would I have to pay $500 a month for 25 grand? 7.4. So the difference between 7.4% and 4.9% makes the same difference as $1,500 on the loan amount. This is why this stuff is so important to understand. One of the things that the calculator will have is what's called a recall button. And we made a bunch of different changes, and I don't honestly remember what is what. So what I want to do is I want to recall the number of months. Okay, we're still at 60 months. I'm going to recall the interest rate per year, 7.4. And how much was the loan amount? Okay, it was $25,000, and my payment was $500. Again, future value is always going to remain zero, so we don't need to mess with that. So this is what we're talking about on a car loan. Okay, now let's look at a house loan or a mortgage. Let's say it's a $300,000 home, and we're going to go 3.9%. And let's go 30 years. That's 360 months. What's my payment going to be? About $1,400. Okay. Now let's say that you decide, you know what, I can spend $1,750. Okay, so I'm just going to throw another $250 a month at the cost of the payment rather. So let's make it $1,750, and remember, since payments are always negative, we got to add the negative. I'm going to say I want to pay $1,750. So now, how many months will it take for me to pay the house off? Months is N. Solve for that. 251. So let's see exactly how much of a difference that makes in the total cost of the loan. So we dropped from 360 months to 251, so that's 109 month savings. So 109 months where we're not making a payment of $1,415 means we just saved $154,000 by paying a couple extra $100 a month. This is why this is so important to understand. There are two types of loans. There's an APR loan and there's a simple interest loan. The APR loan is also known as the rule of 78, because what that means is that the bank gets 78% of its interest in the first half of the loan. So they're pretty much banking on you trading your car early or selling your home early and upsizing or downsizing and not keeping the loan for the full amount. By doing an APR loan, they get 78% of their profit in the first 50% of the loan life. So knowing this really helps to understand what makes a difference with the payments and how you can save yourself some money. On any kind of loan, paying more in your payment, that extra money goes to the principal, that helps. With an APR loan, it is a huge difference. Now, I have simplified this to a fairly large extent, and there is one other factor that we have not accounted for. I'm sure some of you have already figured this out. That $154,235 is 109 months that we're not making the payment of the $1,415 per month, but we're spending more money per month. So let's go all the way through this to make sure that it's 100% accurate. So we went from $1,750 to $1,415. So we're paying another $335 per month. If we multiply that times the 251 months, that's $84,000. So if we take that and subtract the 154, the actual savings on the loan amount is 70 grand, not 154, because you paid more per month. But you physically are not making $154,000 worth of remaining payments. So to be completely sure that we understand what's going on, I've multiplied the difference in payment between 1415 times the 251 months that it's now going to take them to pay the loan off. That's $84,000. We saved 154 total. You subtract the 84, and the actual savings over the life of the loan is $70,000. But what happens is 251 months in, you stop making a $1,750 payment. So for the rest of the loan, if you would have continued to pay that $1,750 for the remaining 109 payments, that's where the 154 comes from. It's still a great savings. It's still a huge amount of difference based on a very small amount of change in your payment scale. So I hope all of this makes sense. If it doesn't, and it probably won't, leave your comments. If you've got a question on a particular deal that you've gone through, I'd be glad to help if I can. Please like, please subscribe, please share. And Jay says thank you.